You're listening to the Financial Source Podcast, your daily dose of sentiment updates in the European and U.S. sessions and critical risk event previews so you stay up to date with what's moving the market right now. Each session is carefully crafted personally by the Financial Source analysts and voiced by our AI hosts who, as it turns out, sound a lot better than we do. Here's Rachel and Michael with this session's deep dive.
Welcome back to the deep dive. Today we are really getting into this global markets, policy, trade, and geopolitics briefing.
Yeah, and it's quite the mix, isn't it? You've got these two huge forces sort of pushing against each other.
Exactly. On one side, central banks hinting at easier money maybe, and then bam, global trade tensions just flaring up.
That's the core of it. So our job today is to kind of cut through all that, right? The FX noise, the commodity shifts, the trade talk.
And find the signal. What's really driving things?
Precisely. The briefing calls it the swing factor. Is it the softer policy path, or is it this rising trade uncertainty? That's what we need to figure out for you.
So are markets leaning more towards, potential rate cuts, or are they spooked by the U.S.-China stuff? Let's start with the central banks, because that's often where the immediate ripples begin, the Fed and the dollar.
Yeah, good place to start. Because over the last few days, the policy talk, it's definitely moved the needle on currencies. The U.S. dollar index, the DXY, it's softened up a bit.
And we heard from Powell himself, didn't we, about why they cut rates back in September?
We did. He pointed straight at increased downside risks to the U.S. labor market.
Which feels like a shift, right? Focusing more on jobs, maybe less intensely on just inflation for a moment?
It does. But maybe the bigger signal, especially for market liquidity folks, was his comment on the balance sheet.
The runoff, yeah. Can you quickly explain what that means for the listener?
Sure. So balance sheet runoff is basically the Fed letting its bond holdings mature without reinvesting the money. It pulls cash out of the system, effectively tightening things. So when Powell hints, they might be nearing the end of that runoff.
That's huge. It's like saying, okay, we might stop shrinking the money supply soon.
Exactly. A potential stop to that liquidity drain.
And it wasn't just Powell, right? Susan Collins in Boston?
Right. She chimed in too, called further easing prudent, even while, technically saying policy is still mildly restrictive.
So two key voices, similar message. The dollar reacts.
And that sets off the dominoes elsewhere. The softer dollar means other currencies get some breathing room, like the euro. It managed to hold its ground. Euro USD stayed pretty steady above that 1.16 level.
Okay. And we saw sterling make a bit of a comeback, too.
Yeah, partly helped by their own news. Governor Bailey over at the Bank of England noted their latest jobs data also pointed to a softening labor market.
So less pressure for them to hike rates aggressively. Makes sense.
Mm-hmm. And the yen firmed up a bit, too. USD JPY tested the low 151s.
Why the yen strength? Just the softer dollar?
That's part of it, yeah. Less pressure from U.S. rates, but also, general caution. Investors still tend to run to the yen when things feel uncertain. It's still got that safe haven appeal, sort of.
Got it. But, okay, the source material points out it's not uniform. If you look down under the Aussie dollar and in Asia, bit of a different story.
Yeah, it gets nuanced there. The Aussie dollar, the AUD, it's actually trying to regain some ground.
Why is that? Against the trend?
Well, it's a local factor. The Reserve Bank of Australia, the RBA, their officials hinted that Q3 inflation might actually be stronger than they thought.
Ah, so potential for hikes down there.
Exactly. And that local rate expectation can temporarily overpower the global dollar trend for that specific currency. It's a good reminder for you watching these things.
And Singapore, they have their own way of managing things, too.
They do. The MAS, their central banks, they left their currency settings, the SGD Naira, unchanged.
SGD Naira, that's the trade-weighted basket thing.
Right. They managed the Singapore dollar against a basket of other currencies. By holding steady, they're basically signaling they expect core inflation to bottom out soon, then maybe rise gradually into 2026.
So local factors matter. Central banks are still looking at their own backyard, even with big global shifts.
Absolutely.
Okay. So force number one. A clearly softening Fed path pushing the dollar down. Now, let's pivot to the counterweight. The thing the briefing says is the real swing factor. Trade wars, U.S. and China.
And this is where it gets really tricky for markets. Because just as they start to price in a bit less risk from, say, easier money,
These trade headlines hit. And the risk-off feeling just floods back in.
Totally. It creates this constant push and pull.
So what are the specific friction points highlighted? The U.S. is still saying 100% tariffs depend on what Beijing does. But what struck me was the sort of contradictory talk, USTR calling China's rare earth actions disproportionate.
Yeah, strong word.
But then also saying recent talks were constructive. It's confusing.
It is. It's like that saying, speak softly to carry a big stick. Or maybe speak loudly while carrying the stick. But it's moving beyond just tariffs now.
Yeah.
We're seeing new tactics, more specific ones.
Like the cooking oil threat. That one seemed pretty specific.
Didn't it? And that's what's interesting. President Trump floated terminating business with China related to cooking oil, potentially as payback for them not buying enough soybeans.
Yeah.
It shows how granular this could get. It's not just broad tariffs anymore. It's like weaponizing very specific commodity flows. Surgical strikes almost.
A whole new level of detail in the conflict. But China's not just sitting back, are they? They're pushing back, too.
Oh, definitely. On the rare earths, MOFCOM, their commerce ministry, they were quick to say it's a licensing framework, not a ban.
Why is that distinction important?
Well, legally and diplomatically, a license implies control, oversight. A ban is a full stop. So it's a way of tightening control while maybe keeping the door technically open. Semantics matter in trade fights.
And they also had a pretty direct warning for Washington.
They did. Basically, don't expect talks if you're simultaneously threatening new restrictions. Fairly blunt.
But maybe the most significant thing, the structural shift, the briefing notes, is less about the talk and more about the actions. Port fees, investigations.
This is key. Forget just tariffs for a second. China started putting special port fees on U.S.-linked ships. And they launched an investigation into how those U.S. Section 301 tariffs are hitting the shipping industry.
Okay, so why is that the really important bit for you, the listener?
Because tariffs are visible, right? You see the tax, these things, port fees, logistics investigations, they're different. They're operational. They squeeze the actual mechanics of trade in ways that are harder to see and track immediately.
Like sand in the gears.
Exactly. It forces companies to maybe rethink supply chains quietly. It makes the friction less obvious, but potentially more disruptive over time. That's why it feels like the swing factor.
So the market fallout from all this back and forth.
Well, the briefing says it keeps underpinning those trade-sensitive currencies. Think the Korean won, maybe the Mexican peso. Currencies tied closely to global manufacturing.
And it muddies the water for industrial commodities. Their demand outlook gets really complicated.
Which leads us right into commodities, doesn't it?
Yeah.
Section 3, caught right in the crossfire of growth worries and these easing signals.
Yeah, looking at crude oil first, prices seemed kind of weak, almost sluggish, which feels weird given all the geopolitical stuff usually propping it up. Why the lackluster performance?
It seems the underlying supply-demand picture is just weighing more heavily right now. The IEA, the International Energy Agency, they actually trimmed their demand growth forecast for 2025.
Less demand expected.
Yeah. And maybe more importantly, they flagged a potential sizable surplus next year. Too much supply, basically. Lots of non-OPEC oil coming online, maybe, while consumption growth looks a bit sluggish.
So structural oversupply fears are capping the price despite other risks.
Seems that way. It's overridden the short-term noise for now.
But then the complete opposite story. Gold. It's been on a tear, hitting records. What's driving gold's strength? It feels like classic safe haven buying, but maybe more complex.
It's getting a boost from two directions, really. First, the prospect of the Fed easing more. That lowers the opportunity cost of holding gold, which doesn't pay interest, compared to bonds, which do.
Okay, lower rates make gold more attractive relatively.
Right. And second, all that trade friction we just talked about, that persistent risk. Investors hedge against that too. Flight to safety.
So gold is hedging against both monetary policy shifts and geopolitical trade risks.
Exactly. That double whammy is really powerful for gold right now.
Makes sense. And then industrial metals like copper, just sort of stuck.
Pretty much marking time, yeah, because it's caught. Earlier in the week, the dollar was a bit stronger, which tends to weigh on copper. But the bigger issue is that demand signal from U.S.-China trade is so uncertain. Stop-start, as the briefing puts it.
Copper needs clear signs of industrial growth, and that's just not there with all this trade tension.
Precisely. Until there's clarity on global demand, which is kind of hostage to trade policy right now, copper's likely to stay range-bound.
Okay, let's widen the view a bit. Europe. Policy and politics there seem to be running on slightly different tracks, maybe less directly hit by the immediate U.S.-China crossfire.
Yeah, there's a connection, but also some distinct local factors. The ECB, the European Central Bank, they're definitely sounding cautious. Francois Villeroy, he's a key policymaker, he basically said the next rate move in the Eurozone is much more likely to be a cut than a hike.
So joining the global easing trend, potentially.
Looks like it. And interestingly, he made a specific point about the trade war impact.
What did he say?
He judged the impact of those U.S.-China tariffs on Eurozone inflation as negligible.
Negligible? Really? Why is that important?
Well, it suggests that, at least in the ECB's view, Europe's economy is somewhat insulated from the direct fallout compared to the U.S. or China. Their supply chains, their consumer base may be less directly exposed to those specific sector bans or tariffs.
Okay. And others at the ECB agree.
Seems so. Gabriel McAuliffe from Ireland added that inflation is pretty much where they want it, reinforces that dovish lean. No rush to hike.
And beyond the ECB, there was some political news helping the euro, too. Something in France.
Yeah, potentially significant political development. The Socialist Party there signaled they would not back a no-confidence vote against the government, even after that controversial pension reform suspension.
Why does that matter for the euro?
It reduces immediate political uncertainty. Less noise, less risk of government instability. That helps clear the way for Prime Minister Le Cornu's budget plans. Stability is generally good for a currency.
Gotcha. Reduces that political risk premium. And finally, just a quick touch on geopolitics impacting energy risk.
Right. A couple of points. In the Middle East, Washington signaled a shift to Phase 2 in the Israel-Hamas situation, aiming for broader peace efforts.
De-escalation attempts.
Yeah, any move towards de-escalation, even just talk, tends to take some of the geopolitical risk premium out of oil prices. We saw a bit of that.
And Ukraine, still a background risk.
Always. President Zelensky is heading to Washington, apparently asking for air defense, long-range weapons. The war itself continues to be this underlying factor for European energy security, gas, power prices, even if markets aren't reacting wildly day to day anymore. It's a persistent vulnerability.
Okay, so bringing it all together, we've looked at the easing Fed, the messy trade picture, commodities caught in the middle, and the European angle.
We have. We've traced those two big opposing forces.
And the main conclusion from the briefing seems to be, well, that markets are basically walking a tightrope, right?
Well,
balancing the softer Fed, pushing the dollar down against this ongoing, unpredictable trade stuff.
that's the balancing act. And the trade story, especially with these new tactical twists like port fees and investigations, that really feels like the wild card, the ultimate swing factor right now.
And commodities are stuck right in that tension, growth fears from trade versus maybe slightly lower geopolitical risk, for now.
That sums it up well.
So this deep dive really highlights how trade conflict is evolving. We tend to fixate on tariffs, those big headline numbers. But here's something for you to think about, a final thought. We talked about China investigating the impact of U.S. tariffs on the shipping industry itself and imposing special port fees. Could this be the next phase? Less about obvious tariffs, more about these technical operational barriers, things that are harder to track but force companies to quietly change how they move goods around the world.
That's a really important question. Is the future of trade friction less visible? More about logistics and technical rules? That's definitely something worth watching closely.
Thanks for listening to the Financial Source podcast. If this podcast helped you at all today, would you consider leaving us a review to help spread the word? Each month, we also give away different resources and indicators just to podcast listeners. So write into Financial Source at support@financialsource.co to claim your free gift today. Talk to you all in the next episode.